Hi, thanks for coming to Money Control, Franziska. It's great to have you here. Uh, Let us first start with the report that you have, uh, and what you've done with India's forecast. I think you're projecting 6.5% growth this year, and for next year you've pared down your forecast. What are the reasons for it, and why the same number despite US tariffs?
So yes, we expect a slowdown in Indian growth from 6.5% this year to 6.3% next year. And that slowdown is in part because of higher US tariffs on Indian exports. But even with that slowdown, India will remain the fastest growing major economy by a margin.
So for this year, when you increased your forecast for this year, what was the reason for that increase? Is that the GST? Is that the good rural economy, or is that the public investment?
Oh, the yes, we did raise our forecast for this year. The main reason was really just a reflection of the recent data release that took us by surprise. That was surprisingly strong. And I understand that was surprisingly strong in good measure because of public investment. But going forward, we do expect the higher tariffs than we had anticipated in April. We do expect them to lower growth going forward.
And can this public investment surge continue? The Indian government is right now, the central government, about 3.4% of the GDP. Can this be increased? Can this continue for a sustained period of time?
So the optimal size of public investment really depends on many, many things. It depends on the investment needs. It depends on the financing of it. It depends on the demand management, the overall fiscal deficit. And really, it has to be carefully calibrated against these different considerations. So the answer to your question is not as simple as a yes or no. It's a balancing act between three different considerations.
So one of the reasons for doing this kind of public investment was to also crowd in private investment. That hasn't happened to the measure that the country wanted in the past because of various reasons, global uncertainty being one, and the animal spirits not being rekindled the way that it wanted to. Uh, what can India do to crowd in that private investment now that global uncertainties have increased much more given the tariffs and other situation?
Thank you for asking that. That's a good question. Because if you look at private investment growth, yes, it's slowed. Indian private investment growth has slowed from pre-pandemic rates. And that is the opposite of what happened in other emerging markets and developing economies, opposite of public investment, your previous question. But Indian in private investment growth is still higher than in the average emerging market and developing economy. So this private investment weakness is only weak by Indian standards, not by international standards. What is weak, and that takes me to the second part of your question, what is weak by international standards is FDI, foreign direct investment. And that is really in the bottom quartile of emerging markets and developing economies. Now, that foreign direct investment usually comes with tradables. Foreign investors usually come in to trade in some form or other. It's usually integrated in supply chains in some form or other. So to your question, what can be done to increase it? Just make the trading regime easier, reduce tariffs, reduce non-tariff barriers, do agree as many trade deals with as large counterparts as possible and as deep as possible, so you really unlock supply chains.
So would you say this is the time for mega trade deals of multilateral agreements as well, rather than just going for bilateral agreements?
A trade deal with a major counterpart, even if it's bilateral and even if it cannot be multilateral, will be a win. Mind you, a lot of these trade deals that are currently bilateral, they are kind of embedded in a multilateral trading system. So just to give you a statistic for comparison, if you take a country like Mexico or Vietnam, they have trade agreements with countries that amount to about 50% of global GDP. That's market access. But for India, the comparable number until the UK agreement was about 10%, 12%. So any trade agreement at this point with a large economy, whether it's the US or the EU or Canada or Australia, will be a benefit. So it's very good to see that the authorities are really pushing hard on these trade agreements now.
Now, moving back to the report and the AI aspect, that's very interesting here. You've said that jobs have reduced in areas where there's about a 20% decline there. Then there's one aspect where there's a 30% increase as well in certain listings of jobs. Right. And I was looking at both scenarios. So is technology labor augmenting? Is it labor supplanting? What is happening here? And if you can explain that paradigm for our viewers.
Yes, great question. It's ambiguous. So the big number, the two big numbers actually to focus on. One is that in India, only 23% of the labor force are exposed in any way to AI. That's much less than other emerging markets, developing economies. But then exposed depends on good exposed, bad exposed. No, it can be anything. It can be either of the two. So we split that. 15% of the workforce, so about 2/3 of that 23%, are exposed in a way that would likely give them productivity gains. They're complementary to AI. So think dentist. No, you'll always need a dentist, but AI makes her more productive. Then there is another 7%, so about half as many people, that are more substitutable, that are in jobs that are more substitutable by AI. So those are much more at risk of being replaced, substituted for by AI. And that number that you mentioned is actually one thing we found in job postings. So we're not talking about people losing jobs. We're talking about job postings, so hiring, the speed of hiring. We do find that the most substitutable quartile of people, for them, the number of job postings has fallen by 10-15% since the release of ChatGPT. But remember that 10-15% is relative to everyone else. So not in absolute terms. In absolute terms, it's roughly flattish. It's relative to everyone else that job postings have grown at a pace that's 10-15% less. But the other thing to bear in mind here is that this number of people who are in substitutable, highly substitutable jobs is 7% compared to 15%. It's a smaller number by far from the number that would benefit from the introduction of AI, adoption of AI.
Francesca, two things there. One, when you talk about productivity, when can we see these productivity gains? Because I remember an old quip that computers are everywhere except in the productivity debate. You will remember that as well, right? So are we going to see these
Yes.
productivity gains very soon, or is this like a 3 or 5 year timeline that we're looking at?
It's hard to tell specifically what productivity gains are due to AI. It's very hard to tell. But what we do know is that the industry that has a lot of complementary people, which is computer services, not just BPO, broader computer services, their exports have risen by 30% since the release of ChatGPT in November 2022, whereas in aggregate services, they've only grown by 10% roughly. So there seems to be a part of computer services that is thriving since the release of ChatGPT. Perhaps these are the productivity gains that you're looking for, but it's very hard to say exactly these are the AI-related productivity gains.
Francesca, the cohort of people that are expected to have an impact, negative impact, are going to be young workers who are entering the workforce and educated workers who are entering the workforce as well. In that cohort, a large proportion would be women as well, if you look at it, because a lot many women are coming to the workforce, they're educated, first time. What does that do to already low labor force participation? World Bank has been talking about India increasing its labor force participation rates from very low levels. How does that impact it, and what does the government need to do to change that paradigm now?
So thank you for asking this. So we have shown in this report that the ones who are most affected by the slowdown in job postings are the younger, so less experienced ones, and the ones that are sort of upper mid-skilled, so just below a BA, a college degree. What we have not shown is the women in this sector. But we have also shown, so the women, I suspect that is your judgment, not your sentiment in India. But what we have also shown in this report is that there is one sector that could absorb, with the right policies, could absorb exactly these people, the younger, the higher skilled, and that links back to our earlier report, women too, the export sector. We've shown that the intermediate tariffs are about double of what they are, more than double actually, of what they are in other emerging markets and developing economies. Tariffs on intermediate inputs are more than double of what they are in other emerging markets and developing economies. If now these trade agreements phased out tariffs, starting with intermediate input tariffs, hopefully, this is exactly the kind of tariff cut that would benefit the jobs where you have younger workers, higher skilled workers, and generally in exporting industries, there are more women. So if you have these tariff cuts, ideally embedded in these big trade agreements that really increase market access and supply chain integration, that is exactly the kind of industry that, at least in other countries, employs women disproportionately. So a package of AI technology adoption that happens anyways, regardless of any policy. It's something that's sweeping across the world. It's a global technology shock. That'll happen. But if you could package that with trade agreements that bring down the cost of trading, it would be a nice opportunity to allow workers to shift from one area to another in a way that adds momentum to the economy.
So, Francesca, within that argument, if I were to ask you, Indian government is focusing a lot on increasing its manufacturing base. We're talking about made in India, and we're talking about taking the manufacturing level to 25% of the GDP, which is currently at 16%. Is the manufacturing sector going to create as many jobs as it did during the previous waves, like the Chinese miracle or the Asian miracle that we saw? Given that the capital intensity has increased over time and robotics and other things are seeping in along with AI as well. So if you look at China, robots per factory have increased like anything. So is that going to create as many jobs?
The answer is twofold. On the one hand, yes, it's going to be harder because global trade is not booming the way it used to. So for anyone who lowered their tariff barriers in the mid-90s or early 2000s, they would have ridden the global wave of global trade. They would have benefited from that. That's not happening now. Global trade at the moment is more flat in percent of global GDP. But India's market share has a lot of room to grow. It's almost a low base effect, because currently its general openness, export to GDP ratio, is in the bottom quartile of emerging markets and developing economies, especially on the goods side, not so much on the services side, but on the goods side, it really has a very low goods export to GDP ratio. So simply the low base effect could generate a lot of growth, a lot of dynamism, both in investment, and including FDI, and in job creation.
A section of your report also deals with these deficiencies that exist in the market, like the Industrial Disputes Act you talk about, and how it is very difficult for companies to scale up beyond the point because the cost increases are much higher. The cost increase is about 35%. You talk about internal migration issues also and all. So first, focusing on this, what are the reforms that are needed for India to grow at that 8% target that it wants to achieve, that Viksit Bharat goal?
Yeah, no, thank you. So it's actually across South Asia. It's interesting. The vast majority of firms is small, but not just small, old too. What seems to happen is that there are lots and lots of small firms are founded and they never exit, they never consolidate. As a result, the average firm age of all these small firms is much higher than the average emerging market and developing economy. So the reforms that are needed are to remove obstacles to firm growth. That is exactly, I think, I understand, what the Deregulation Commission is trying to do. identify obstacles that are preventing firms from growing, and removing them step by step. And it's exactly the right approach, but it could be even more powerful if it was embedded in a market expansion, like, for example, through trade agreements. So if you had the trade agreements, the technology shock, plus the domestic deregulation, that together could be a powerful package that really transforms the firm landscape too. Probably with a focus on manufacturing, because that's where really the India lags the rest of, at least on the export side, it lags the other emerging markets, developing economies.
One question is on the logistics side. There are a lot of reforms that are needed on the logistics side as well, as I need to understand the costs are too high. What do you think should be the best direction in that sense? And the second question is, in that goal to achieving a developed economy, your potential GDP also needs to go up. Right now, if I'm not wrong, the potential GDP is somewhere around 6.5 to 7%. How can that be moved up to the 8% mark in order to achieve that goal?
So on logistics has many elements. So the infrastructure, the government has done a big push on infrastructure. It's really quite modern in many pockets. So, but it has other elements too, which is removal of monopolies wherever there are monopolies in the transport industry, or oligopolies in the transport industry. It's also red tape. So it needs action on all of these. And again, maybe that's one of the things that the Deregulation Commission will pick up. On potential growth, I mean, the hope is that these trade agreements will just create a whole new set of markets that could lift potential growth, simply because there is a bigger market to integrate into, a bigger, richer market to integrate into.
That's about
AI
it.
could also be the productivity shock. It's quite possible that AI is a productivity shock that makes everyone so much more productive that you have a higher potential growth. But I can't give you
I
numbers because I don't know.
I I hope it doesn't turn into the computer kind of productivity where productivity only came in the later half of the 90s, and from 80s we
Yeah.
started using computers and it took about 15 years. So thank you. Thanks a lot for coming on the show. It was great to have you with us. Right. We would love to have you back again. Thanks a lot.
Thank you so much. A pleasure. Thank you.